welcomed another episode of the Wealth and Business Podcast, hosted by Dr. Daniel Moses, founder of Property Wealth Corporation. In this episode, recorded during a Q&A session at our private Members Club networking event, we have a very special guest, Ola Soaga, financial expert and CEO of Cedar Blue Accountants. Ola and Dr. Daniel go way back, and today they're here to share powerful insights on good debt versus bad debt and how to use other people's money to grow your property portfolio. If you're ready to unlock the secrets to financial success, let's dive in.
I've known Ola back in the days where I used to be a taxi driver, and he was my accountant when I was a taxi driver. And I remembered when we started doing what we're doing now, and I remember borrowing the first amount of money I borrowed from someone was £3,000. Guys, do you know how hard it was to borrow £3,000? It was blood, sweat, and tears trying to borrow £3,000. And I look back now and I'm like, whoo. And I remember going to Ola as my accountant. I'm like, I'm trying to borrow £3,000, and he's like, but why do you need to borrow £3,000? You don't need to borrow money. Find a way to get...
Not exactly in those words. Like.
Kind of like find other ways. And we both went on the same journey. And together, he's been my accountant like 7 years on. So these are people... People I bring on my stage are people I have like really strong relationship with, because I don't want a situation where I bring in the wrong person and then you say you met that person here and it get a bit messy. So without further ado, I wanted to introduce my personal accountant, the founder and CEO of Cedar Blue Accounts. He is a financial... You're
still hyping it up.
Okay, I'm still hyping. He's our non-executive financial director. And yeah, please welcome Ola Soaga. And for every member of our club, he's also our preferred accountant. So if you become a member of the club, you don't ever have to worry about anything about your finance. We always refer people to him. And to be honest, most of our members, he's obviously looked after them really, really well. So one of the reasons why I brought him tonight to talk about accounting and talk about leverage a little bit is who here in the room has actually borrowed £3,000 to do property like me in the past? £3,000. So we're going to be talking about good debt and bad debt. So first of all, Olani, I just wanted to get the audience to know you. So tell us a little bit about yourself. And he's also a property investor. A little bit about yourself and your background.
I thought you did that already. So my name is Ola Soaga. I'm an accountant. I've been an accountant for the last 17 years. I work in industry, banking specifically, and I own my own practice. So I'm a consultant within the banking industry, and I own my own practice. I've owned it for 10 years. And as Daniel said, I am Property Wealth's preferred accountant. So a few people in the room already know me because I'm their accountant, and a few have spoken to me already. I'm a father of 3. My wife's at the back there. She was deputizing for me while I was fucking the train station. Essentially, my passion is to help people understand finance and understand investment appraisal and understand what's good money, what's bad money. And yeah, I'm here to take any questions to clarify and learn as well at the same time. Yeah. A funny story Daniel was telling just now. I remember the first time I reviewed the account, and the account was a mess in my own definition, right? There was money going left and right. And I was like, why is money going all over the place? And he was like, oh yeah, this is how I'm building my property portfolio, other people's money, right? And I'm like, no, you don't need to do this. You need to save. Because I'm an accountant, right? You got to be cautious. You need to save, build your property portfolio. And was it 4 years after?
4 years after.
I did exactly the same thing. So it took him 4 years to convert me, but it did eventually, because we have a property together. And I think I invest about 90% of other people's money in that. Mm-hmm. Yeah. So I'm fully converted.
So for those you talked about bad money and clean money, which would be good money or bad money as well at the same time. what is good debt and what is bad debt, and how can people here in the room understand the concept of both so they can actually use it to create wealth for themselves?
I mean, debt or liability, if you want to call it, the purpose is what defines if it's good or bad, right? If you understand the concept of liability, other people's money, and you understand the concept of asset, which is what you own that generates cash for you. So if you owe someone money, but you used it to generate an asset, that asset returns money. That's good, right? Because you've got an asset to leverage on and you've got inflow. But when you generate debt to incur things that don't return anything to you, we call that bad, right? And most of the wealth people in the world have used debt to build what they have today, right? The concept is, can you make the difference between the repayment of your liability and the income that comes from your assets? As long as there's a positive difference between the two, you're on the hop, you're on the ascendant path, you're increasing your personal wealth, you're increasing your cash flow in your lifestyle, etc., by not using your own money. In a corporate world, actually, the liability is built into a company and you're protected from it, while the assets, you can gain the income that comes from it. And should things go south, most likely the company goes down, but personally, you do not incur. That's what we call limited liability company, right? The debt is limited to the company. I'm not preaching that you run your company into the ground, but essentially you get that protection by using debt and not necessarily your own personal money.
Great. So, I mean, you've used other people's money to buy properties before.
Yeah.
So none of your own money. Who here in the room would love that? Who here would love to use other person's money to buy a house? Sure. Let me see the hands higher. Okay, so what I want to do now, I really want to open the question to you. So can we start passing the mic? I'll take 5 questions. Who here would love to use other person's money to buy property? And if you have any burning questions, please show of hands and we're going to bring the mic to you. What question do you have to ask Ola? By the way, can I just do the honors of introducing Jennifer? Jennifer just contested on the just concluded elections to represent Tottenham. So can everyone please just give her a hand of applause?
Labour or Conservative?
It says Labour or Conservative.
Yeah, thank you. My question is, when people raise capital from others, often they're not sure about structure. And though I've been introduced as a former candidate for, let's say, as an MP, I'm actually a lawyer, and I'm also an auctioneer. I have an auctioneer's license. But as a lawyer, what I find is a lot of people don't really think about structure and what happens if things go wrong. As an accountant, what would you say would be the safest way for people to structure themselves in order to raise that capital? Or if an individual is going to others to raise that funding, should it be as a company? Should it be with a loan agreement? What do you think is best?
I think you need to have both, right? We talked about limited company. You need to insulate yourself from the capital you're raising. So personally insulate yourself. And that's best done through a company, right? Company by the definition is limited by shares. And if you raise capital with that company, the debt is limited to the shares you have in the company. And also it's important you have a loan agreement. It's important you evaluate your interest rate or the rate you're paying back on that capital. Is it worth the deal you're about to put it on? There's no point raising debt at 10%, but your asset is only going to generate you 8% in the long run, right? You're in a deficit of 2%, right? So those are things you need to think about, and it's also good to have terms of agreement. In terms of if things go south, if, for example, you might raise from a friend, right? And you don't want to insulate yourself from that friend because you don't want the friendship to go south, but there's still things you can do within your agreement that kind of reaches a broad agreement in terms of if you're not able to repay on time, is there flexibility to renegotiate that term, and etc. I think Daniel does that quite well, right?
Yeah.
Renegotiating your terms. I remember we ran into difficulty in one of the capitals we raised, and I was on the phone to him, and he said, just renegotiate your terms. I'm like, it's not that easy to just renegotiate your terms. But he does that quite well. So if you want to talk about renegotiating terms, I think Daniel is the right person. He will be on the phone to you to renegotiate it, surely.
Yeah, absolutely. When it comes to, I mean, this is pretty simple, right? So I learned this really well with one of my mentors. Most business that starts, in the UK, people are very negative about a business not making profit within the next 1 year or 2 years after it's been set up. But the truth is, if you look in America, I learned a lot of stuff in the US. One of my mentors is a multi-billionaire in the US. One of the things he told me, he was like, if you're thinking you want to make profit in your business for the next 5 years, forget about business. He said, forget about it. But if you're thinking, how do I leverage my business in 5 years and how do I leverage in the next 5 years, then start coming out clean from 10 years later, then you're on for a business. He says, because I'll give an example. Facebook, when they raised money, all right, to be Facebook. It was about to fail. They went back, they raised more money. So they restructured the debt. So they kept restructuring the debt until the debt started to make them profit. And then they paid off their debt and started to work on their capital. Same thing. But the biggest problem is that people are always panicking when you take money from someone. If the time is coming to an end, if I don't pay them, I'm going to die. No, actually, you're not going to die. They're human beings. If the money is in the bank, right? If every single one of us right now, we all back with Barclays. If you pull your money out on one day, Barclays is gone. That's the truth. Any institutional lender out there, if the entire customers that these people have go to the bank to demand that money tomorrow, the bank,
they will not be able to pay.
They can't pay.
That's quite simple.
That's the truth. Yeah. So, and that's the reason why the bank will always keep you happy, give you all the incentives to keep your money there. Resolute recently has been trusted with over $450 billion. Resolute is less than 10 years old. So that's your money that they're lending out. So what the bank got good at is renegotiating terms with their stakeholders and continue to lend that money out, distribute a little bit of a percentage and make the larger profit. And that is the same mentality you have to have when you're raising money to build wealth. So you have to be great at planning for time. If something happened or if a deal goes south, how quickly can you raise money to cushion the issue? Where most property developers go wrong, or where most business people go wrong, for someone who, like me, I've raised over 2 million from social media, and those people became friends of mine, I've paid 75% of that money back. But one of the things was, I do whatever it takes to maintain my dignity, my credibility, and to making sure my investors know I'm happy. And I always tell them, they say, what if the worst go wrong? I say, well, I've got a couple of million sitting on the asset. So if it goes wrong, like John said, sell something. Okay? Sell bloody. Just sell it, bloody. If you bought it before, you buy it again. So the mindset of raising money is like that. So when you're raising private investors fund, your mindset should be flexible. And your mindset should be elastic. It should be able to expand, compress.
Got to be able to adapt.
You've got to be able to adapt always. So that's why it takes a skill to raise money. Not everybody can do it. But it's a skill that can be learned. I learned it. Anybody can learn it. So like he said, 4 years ago, 7 years ago, he wouldn't do it. But now he's done it. He's buying assets. He's building business. Guess what? A lot of business out there is being built on debt. I kind of hope that helps. Next question.
Sorry, a quick one. Just for education purpose, I understand, like, I have a very good accountant, so it's great to meet you. It's never too much.
Thank you.
But I have been able to raise money, and the amount of money I've been able to raise, I was able to raise them systematically. And I'll give you an example. I've helped a lot of young people, more than 20, to buy houses. Yeah. I tell them, I have this information where you can raise loans without showing on your credit rating. And you pull your back, you buy a house, you get back to the bank. I have all the strategies. I've helped over 20 young people buy houses, even with credit. We're getting none of them.
With bad credit.
Like, I'll tell you, cooperative societies.
Okay,
like that,
okay.
All right? Where it doesn't show your credit rating, you pull out the money. I've done it for lots of young and old people. And they keep on how to do it. So, but the problem is, I know how to, because I have built a portfolio. So when I wanted to raise money, I know how to move money from here. You're an accountant. We do all those things like, okay, I'm expecting the money, you give me this, let me sort it out.
Intercompany transactions,
But I've been able to, for example, in this family, I always tell people, if you have a brother, we're going to move you through the chain of your family, because the lawyers will ask you the source of
the funds.
If it's your family member, it could be given as a gift.
Yep.
So you could use it for what you want to do. I've been hearing Daniel talking about forming a consortium, bringing people together, and using one person who has a good credit. I just want a bit of education.
As the director.
As a director,
yeah.
Will there not still be issue of, okay, we want to know more about that person?
There will be. Yeah,
Yeah, there will.
There will be. You have to prove the source of your fund, regardless of how much you move you around. Yeah. Okay. So there would be, but there would not be. Sorry, is that the end of your question?
Yeah,
not to cut you. Okay. You still have to prove the source of the funds, but there wouldn't be any deep evaluation into those people because they're not directors in the company. The person with the responsibility is whoever you select to become directors. And if the people have invested as individuals, it makes it less burdensome in terms of compliance. But if they've invested as limited companies, then that becomes a little bit more difficult. They would have to kind of go back and check, do due diligence on the companies.
So just a top-up question. In terms of the director, with the earning of the director, the person must, it means the director has to be very solid to be able to pull that amount of money alone? Or
but those funds are either gift or loan, right?
No, for example, when you form a consortium.
Yeah, it depends on how you structure the money. You either do it as a gift or
no, but if you're still buying, the bank will consider what the earning of the director.
Oh yes, they would. If it's your first property, yeah. If it's the first property in the company, yes, the income of that director matters. Yeah. But when you're doing the second and third property, it becomes what it's about the company now, not necessarily the director. Yeah.
And just to add to that, right? The easiest way to look at this is this is what you could probably a lot of people don't know. To buy an investment property, you only need to prove a minimum income of £25,000, regardless of what the property is valued at or whatever the income is, because most time it's subject to what the property will generate as an income, not against your earnings. So £25,000 is what you need to prove. Buy-to-let mortgage, case closed. But when you're buying a personal property, all right, in your name, all right, not a buy-to-let, is subject to your affordability. So affordability is usually 4%, so 4 times or 4.5 or 5 times. Do you understand? So if you cannot buy a property for £300,000 when you're earning £25,000 because your income doesn't add up. Does that make sense? So that's that.
I also noticed some lenders, even though it's buy-to-let, they still want to make sure they keep it.
It's usually on the first property.
Yeah.
It's usually on the first property. Another thing to be aware of is most likely most lenders will require that directors personally indemnify the loan and sign a personal guarantee. On the first property mostly. Once you're going away from the first property, it becomes about the business, not necessarily about the director. Because it shouldn't be about the director, right? But banks are edging their risk, right? They're trying to put that liability on the person so they can do affordability, personal guarantee, etc., etc. But in my experience, it's mostly on the first property. Once you can now prove to them you're a property investor by going to number 2, number 3, those kind of criteria are not necessarily looked into.
It's a question about an intercompany and the advantage of it. So my understanding is that if you're an intercompany, you have the advantage of the debt being limited to the company liability. However, a lot of the loan agreements I've seen, there is a personal guarantee from the person to the limited company to pay that debt off. So if you are offering a personal guarantee, does that then nullify the advantage of the limited liability?
Yeah, it does. It does, because you're essentially waiving the covering you have from the limited liability. You're effectively waiving it.
Right. And every loan agreement will have a personal guarantee.
Not necessarily. Not necessarily. No. Not necessarily. It's all about risk for the financial institution. And they do that mostly to newcomers. If you're new in the industry, you're most likely going to sign a personal guarantee.
Yes. Would you advise to buy on a limited company or individual name?
Without even thinking about it twice, it's straight up. You're buying investment properties. Buy it in a business. Buy it in a company because it's a business, right? And the reason why it's very important, because currently with the current tax regime, we've got Section 24. If you can't deduct a lot of cost of your cost of running a property business in your name. But in a company, you can write a lot of expenses off as a business, because a business will pay expenses. So, for example, imagine owning a property, all right, in a company, and you've come here today. As little as your water you drank can be written off. You know, the cost of this ticket is written off. But if in your personal name, you can't literally write down, you know, a lot of taxes. And plus, we already know, right, the tax bracket, if you're earning above £50,000, you're paying 40% tax. So if you own one buy-to-let property that gives you £20,000 net, and you have an income that is £40,000, if you bring both together, your first £50,000 is taxed on a lower tax band, but £50,000 and above is taxed as a higher tax band. So it makes more sense, you know, to buy properties on a limited liability company.
There's a small nuance, which is what every accountant will tell you. It depends on your personal circumstance. While everything that Daniel says is correct, but there are times when buying in your personal name is more efficient, but only a very small subset of personal situations. Most often than not, buying in your limited company is what's the most efficient. And I'll give you an example. If you don't have any income at all, it might then begin to make more sense to buy your first property in your personal name. So that means if you don't have any income and you don't plan to have any personal income, because then you can utilize your 12,570 personal allowance, while you would not be able to deduct your rental income if you were doing your, not rental income, your mortgage payment, if you're doing it in your personal name, but then you get that uplift of 12,570. Then you'd have to check, is that worth me buying in my personal name just for that advantage? Or am I better off in my limited company and being able to deduct all of these great expenses that would not be allowed under an individual name? Yeah. So there's small times when it might be better to buy in your personal name, but 99% of the time you need to be in a limited company.
So, guys, ladies and gentlemen, please a massive round of applause for Mr. Ola Soaga. Thank you.
Thank you very much.